we are benefiting enormously in our national budget by the fact that interest rates are very low. And so interest cost has not gone up as you would have anticipated if you were looking at the scene 20 or 30 years ago with the increase in national debt. Austria issued 100-year bonds, at 2% or thereabouts, and then they've gone way, way up. And I think maybe they yield 1.1 or something like that. I don't know where they are now. But it's great if you're a borrower to have cheap money. I mean, everybody should refinance their mortgage. Under the present slope, it still would cost more to lengthen it out, but you're lengthening it out at very, very low rates. And it would be what I would be inclined to do if I were Secretary of Treasury, but I'd have missed a lot of bets in the last 10 years too. I like to buy stocks, so I don't wish ill on anybody else, but I like to, if they want to sell them to me cheaper, I prefer it. So if that's a, roughly a 3% decline or thereabouts, I don't know how many 3% declines I've had in my lifetime, but there have been a lot of them. And I can't think of one that you shouldn't have bought on, basically. That doesn't mean stocks are going to go up or down next week or next month or next year. But if there's something, if you like to own American businesses, you're getting a chance to buy it 3% cheaper. I don't consider that a lot cheaper. I mean, but how can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off. If you don't have to sell them, I mean, somebody can come around and offer you a quote on your house today, and it can be 2% less than they offered you yesterday. But if you like the house, it really doesn't make any difference to you. Well, we certainly won't be selling, and yeah, we could easily be buying something, sure. Well, conglomerates have had a bad name, and for good reason over the years. I mean, I closed my partnership up at the end of the 1960s, and there was a very abusive run in conglomerates where they played with numbers and they had dirty pooling, as they called it, of accounting. They wanted to have their stocks up and put out stories to do it so they could issue more stock. They were kind of chain letter arrangements. There've been a lot of bad conglomerates, and probably disproportionately so compared to sort of honest to God single industry businesses over time. We don't think we're that kind of a conglomerate. We've certainly never wanted to issue shares. We've never touted shares. And it's done for business reasons in our case. The interesting thing is, of course, is the American public has been going wild in their enthusiasm for conglomerates in the last few years, if you think about it. I mean, it's been an incredibly popular area, but they call them index funds. Oh. You buy 500 businesses.
Trying to figure out what you were talking about.
Yeah, well, 500 businesses all put together. I mean, that's the ultimate conglomerate, isn't it? I mean, I've recommended index funds to lots of people, and when they do it, they're buying into 500 businesses. And they're going to have 500 businesses a year from now and 5 years from now, and they think that group of businesses that will do very well. Our businesses are run by separate people. I mean, we just finished Valentine's Day, and I did not select what pieces went in the boxes. and it's probably been 10 years at least since I've been to a See's Candy factory. Now, I get the figures every month, but I don't know how to make chocolate, anything of the sort. I don't pick out the new locations. We have managers for our businesses that are very much like the managers we have for the businesses that we own pieces of, like American Express or Coca-Cola. And there's a couple things we can do. We can determine the dividend policy of our subsidiaries. Mm-hmm. We can control their capital allocation to some extent, but on most capital allocation, whether to buy new equipment or anything like that, they make the decision. The BNSF Railroad is going to spend $3.5 billion on. I don't approve a single dollar of that in terms of capital expenditures. They know what they need to do, where they need to lay track, how many locomotives they need, whatever it may be. So our managers are, I would say, in a sense, they're almost more independent than the managers of the S&P 500 who go around and report to Wall Street week after week. They go to investor relations meeting, and they're always explaining what they're doing and trying to get the approval of the analysts and all that sort of thing. And we just tell our managers to do what makes sense. We can move capital within. If you move capital from one stock to another, and you had a gain, particularly, I mean, you pay a tax, and may pay a dividend tax, or if you sell, but there's a lot of taxes incurred in moving from one business to another. either at the corporate level, in some cases, but certainly at the individual level. And we can move capital. Well, just take See's Candy again. We bought that in 1972. We've moved several $1 billion from the candy business to other types of businesses. And we'd love it if we could use it all in the candy business, but it just isn't that sort of business. And in addition to that, we free up our managers from all dealing with Wall Street, dealing with bankers, dealing with all kinds of things that are what I regard as less productive use of their time. Well, we notice what other railroads earn and when their margins are better. I mean, and we certainly put way less pressure on than Wall Street might, who would want it next week. But our managers are well aware of what's going on in other industries, and we've made changes where we don't think some businesses are performing as well as they should. But overwhelmingly, we've got managers there that are very, very good. They've got capital available to them for anything that makes sense. And we decide how much they distribute, where the capital moves, and sometimes it moves from one industry to another. And in certain industries, a consolidated tax position really is very helpful to us. We bought control in 1995. We had about 2.5% of the market for auto insurance, and we're at about 13.7% of the market. So we've gone from $2.5 billion of premium volume or thereabouts to $35 billion of premium volume. We're number 2 now to State Farm. We were number 6 or 7 at that time. So I would say that not due to Berkshire at all, but due to Tony Nicely during almost all those years. GEICO's been the envy of every other company in the auto insurance business, except for Progressive, but they've done a good job too. But GEICO is worth tens and tens and tens of billions more than when we bought it, in addition to all the earnings we've given, just the goodwill value. So that's been extraordinarily well run. And with Burlington, I think we paid a dividend of $5 billion last year, and we paid $35 billion for it. So it's gained in market share in its business. Its operating margins have improved, but they haven't improved as much as some other railroads.